All right. Good morning, everybody. We made it through the holiday. And so far, September is living up to September's expectations. Seasonally, this is a negative month. But if you factor in the election seasonality, then it doesn't always turn out so negative. Something to keep in mind. Red on the screen around the world, Japan also came out saying that they're willing to continue to raise rates. That's going to throw the carry trade into fits. The sell-off in August was directly attributed to a lot of different things, one of them being Bank of Japan and the carry trade, one of them being jobs. And this week, we're getting the same jobs data that we got in August when everything sold off. So it's come back around again. Something to keep in mind, right? This whole week is going to be about jobs data and Japan. So you want to keep a close eye on anything coming out of those two data points. Small caps are down the most, 1%. Hong Kong at 0.5%. The Dow at 0.5%. S&P. And Germany's down the least, although there was a lot of data coming out of Germany this morning too. Short weeks always mess things up. We'll get into how this is going to mess with you as a futures trader, but just keep in mind, it's going to also affect the options markets. It will affect crude too. Generally on short weeks, the Wednesday crude report will come out on Thursday, and we'll get it the same time we get nat gas. We have auctions today as well. Remember, if we have any, then we assume that we have all. So this is showing 11:30. Go ahead and assume that we have some at 11 and that we have some at 1. Even if you don't see them, there's a lot of economic events that don't show up, and it doesn't matter how many sites you go to, right? You can go to as many as you want. There's just some that don't show up. They're deemed unimportant enough, or nobody's interested in them. And right now, there's an issue with the auto sales. FX Street is showing we're going to get them today. Market Watch is saying it's to be announced, and they have it for Wednesday. So Finance Juice doesn't have it at all. There's always some issue when it comes to short weeks, things getting moved around. Keep your eye out on those auto sales. I'm going to assume right now that FX Street has it right, and that we're going to see the auto sales today at 3:30. If not, then we'll just continue to look and try to figure out when they're going to be announced. All right, so the issue with a short week when it comes to the futures is how the broker will show data, especially if it's at the start of the week, and how we want to deal with our levels and ranges. So take all of the data from Friday to now and treat it as just one large Globex overnight range. I know you see that we were open in the futures yesterday, but just treat the whole thing as one entire Globex range. And so in all of your approach, just take it from Friday, consider yesterday being Friday. It'll make things a lot easier for you. This is the range that we have to get out of and just lump it all together as a single Globex event. That'll give us something very clear to define, like our halfback from Friday, which we're down there testing now. It gives us the liquidity zone across the top. This is where we will expect sell side liquidity. And down here, this is where we will expect buy side liquidity. For the midpoint that I just erased, there's a cog line down here at 5632, 5630 area. Just, it's the halfback and it's a cog line. I think I'd rather lean on the cog line than the halfback itself, but either one of those, we'll just consider it like a zone anyways, because there's a plus and minus to that halfback, right? So that's your range for the day. It's not really a massive range, you know, shouldn't be too difficult to maintain such a perspective. We are closer to the lower ADR than we are the upper one. So it's more likely that we go and tag that lower one first before we do anything else, but it is underneath the halfback. So when we look at it from that point of view, getting below the halfback is not a good thing, because then it's going to be more difficult to do anything else. So we got to get below this half to hit this ADR, but we're closer to that lower ADR than we are the upper, and it's more likely that we hit it. The low of Friday is just a little bit lower than the low of Thursday. It was the same, drawing the same setup, right? If we just move all of that for a moment, we had Thursday's range when we went into the trading day on Friday. And if we had measured it like this would have been the buy zone on Friday, right? So it's just the same step all over again. Now we're measuring Friday and we're looking at today. If we overshoot Friday's low, then that'll be what we're looking for, is that buy zone down there. There is a cog line at 55.92, which is within that buy zone. So, you know, it kind of ties in with another level of support down there. If we get through this zone and buyers don't defend the range and we manage to expand, then we've got 55.72 as the full ADR level. Right now, we've got a 21-day average daily range of 84 points. Well, that's 42 to the upside and 42 to the downside from the Globex open last night. Although last night would really be Sunday, right? Notice how the ADR didn't even register Monday as a day. This entire thing is just one big Globex. So from Sunday night at 6, $42 higher, $42 lower, that's the ADR half. If we went $84 in a single direction, or 84 points, then we would move up 84 points. We'd be at 57.40, or we would move down and we would be at 55.72. See how that works? Nice, simple, easy. We're still moving farther than we're supposed to. The daily expected move is 45 points, and a 1 daily standard deviation range is 54 points. For the floor pivots this week, we've got the weekly floor pivot that we're resting on right now. We're already through the daily pivot. We broke down through it. Because of the holiday and everything, it's not showing a pivot for Monday. But if we look back at Friday and then look at where we are now, the floor pivot for today is outside of Friday's range. What we're comparing is this pivot down here versus this pivot right here. Friday's central pivot range, which is the yellow lines that are on each side of this purple line, It's a very narrow range, all things considered. It's not as narrow as it could be. The narrower the range, the more likely it is that breakouts stick. The wider the range, the more likely it is that we don't break out at all, or that if we do break out, that the breakout will fail. Now, these ranges don't make price break out. They don't make range go sideways. They don't make price do anything. We're trying to gauge if we get a breakout today, could that breakout get legs and continue to expand? That's really what we're looking for here. Spot Gamma's founder's note has a 0 gamma reading, and it goes from a -4 to a +4. So at a -4, breakouts can really grow legs and expand. And at a +4, we expect breakouts to fail and we'll just come back in the range again. It's the same question that we're asking with the channels here. If we break out, could it really grow legs and break down and break out? The spot gamma's gamma index is at 0 right now, or less than 1, right? It's like 0.5 or 0.7, something like that. So we're basically at the 0 line. It's not at a -4, it's not at a +4, so no real help there. And today's channel range, it's really wide. So that isn't to say that we can't break down or that we can't break out. It's just to give us an idea on what to expect for the day. So the baseline bet is that a breakout or a breakdown will fail. Now, to be fair, consider how far we have to go to get that breakout or to get that breakdown. We're in the middle of the range. If we're going to break out, we got to run all the way back up to 56.70 and then get above that and continue to expand to the upside. Well, that's a long ways off. On the other hand, to break down, we've got to get all the way down to 55.86 or even just 55.92 cog line and get down there. So we're in the middle of the range. And Friday is the boss. We got to get out of Friday's range. Then we got to get through these zones. Then we can focus on expanded targets and where we would go next. We have last week's point of control, 56.30, which is right around that 56.32 cog line. They're just stacking up at that level, right? You can see how we've got more and more and more levels at this 56.30, and it needs to hold. Now, we've cut underneath it, and we're just chopping here down at the bottom of this range. And so the exact level isn't a support or resistance anymore, but this zone now is our zone of importance. If we can come back up through the top of that zone, then we could try to get back to the point of control for the current week, get back inside these value area lines and back into this upper profile zone. But if we break out of the bottom of this new range, then we're going to challenge all those levels that we had mentioned already. 56.11 cog line, 5600 round number, 55.92 cog line, then down into last week's levels, underneath Friday, underneath Thursday and Wednesday, and on down we go. We've got the 3-week moving average right underneath this, 56.22. We have the 10-day moving average underneath this, the 20-day, the 10-week. So we've got a lot of things down there that are going to be like branches in a tree. You know, you go to fall out of the top of that tree, you're going to hit every branch on the way down. They're not necessarily representative of support. They're just areas of interest where we could expect to see some trading activity, but we want to look for that activity to actually be there. Look at the dome, see the tape when we get near those levels, the trading activity, increased volume, all of that sort of stuff, right? Not just marking out the line and expecting it to be some sort of support. They're just areas of interest at the moment. We're at the volatility trigger. It's kind of a key level. Now, that's a spot gamma level. And spot gamma's got, even for people who don't have a spot gamma account, they've got public pages, which gives you a chance to go over and check things out, like the volatility trigger. For them, this is one of their proprietary levels that's really important. It's a key level. When we get underneath this, price can really expand, right? And say we were 200 points below it, price could expand to the upside a long ways. So it's not saying that it's just expanding to the downside. Price can move a long way in a single day when we're underneath the volatility trigger. Underneath it, they've got something called bearish feedback loops. And when we're above this level, they expect relatively lower market volatility. It's the last major support above the put wall. That's their words, not mine. So if this last major support breaks, the next major support level is all the way down at 5,500. They didn't have the AM edition notes when I started streaming, but I noticed that they do now. So I'll get those shared out in just a minute. Maybe they'll provide some insight on the zero gamma level, because that's also a level that we would have to get through to get to that put wall. And nobody's saying that we're going to go there today. We could, because price can do whatever it wants, but we're not expecting that level of violence this morning. We do have a lot of volume, though. 97,000 in the volume. It's the first time we've had that level of volume since Thursday, with that really big day that we had back here at 89,000 volume. So we really want to see this volatility trigger hold. It's like the line of last defense. Ten-day, 30-minute volume profile. This point of control is not expected to move anytime soon. We talked about this last week. There's no way that we're going to see this thing move unless price expands either up or down away from this zone and then gets a lot of volume at that new location really fast. Otherwise, this is likely to be our point of control for at least a week. And when we're in the range, then coming back to that range is just going to mean that we just chop back and forth. We have to leave that range far enough, get away from it enough that it actually starts to act as some sort of support and resistance. We haven't had that, right? You can see we just keep crossing through it. When we've expanded the range, it was a lot tighter, but we expanded that range considerably and we still just keep chopping back and forth through it. So don't think of it as a support and resistance level right now. Instead, think of it more of like gravity or a magnet. We just keep coming back to this level. When we sell off, it's been bid right back up again. And when we've tried to break out, it's been smacked back down again, right? So we got like this really tight ceiling that we haven't been able to get through. And on the lower end, we continue to test lower lows, right? From this key low back on last Thursday, two Thursdays ago, then Wednesday into Thursday of last week. So something's got to give, but right now we're just building up more and more and more structure at this level. 5x5 chart, 5-day, 5-minute. We cut through that level Friday afternoon, going into the close, and we can now take that level and just use it down here. On Friday, we set the point of control in the lower part of the day. 5611 cog line is right underneath this point of control. So if we continue to move to the downside out of this current little range that we're in, 5611 cog line is a key level I would focus on. But before we get there, we have a point of control we're likely to hit. We've also got a Globex low down here at 5608. It's really close to the 5611 cog line, that whole little area, right? So 14, 11, 8, one wide range or zone. Then Thursday's low, Friday's low, round number. It's a lot of structure down here. The question I keep coming back to is what's going to get us out of this box? What's it going to take to finally get us out of this range? And on the top side, that box goes back a lot further. Right now, we've got a little bit of a discrepancy between these two profiles. The one in blue is called TPO. It's time, price, opportunity. I know they both look like a volume profile, but the green one is a volume profile. We call that volume by time. The other one's a volume by price. The point of control is where the greatest amount of volume took place on the green one. And in blue, it's where the greatest amount of trades took place on the TPO. So we had a lot more trades up here, but we've had a lot more volume down here. That's the discrepancy this morning. Generally, when we see this kind of volume, it's because we hit some sort of iceberg. If it was overhead, we'd say we hit some sort of ceiling. So we came down and we landed into a massive pool of liquidity. And the question is, did we absorb it all? And is there any other levels? You could use things like Bookmap or Jigsaw, or even just look at the dome and see if you can spot those levels down there. The other issue with a short week is this weekly expected move indicator. You can't rely on them on a short week, especially on the first day. So it's just janky, right? There's nothing we can do about it. The reason for it is because Thinkorswim doesn't allow us to code indicators in a way that can get to the data that it needs. This is the data that it needs, right? It's using the expected move that's right there, that plus and minus level. And it can't read any of this because there's just no way to code an indicator that can see this. So the person who created that indicator, his name is Mobius, he found a different way to do it. And most of the time it works pretty good. Just during short weeks, they're janky and you can't trust it. You have to go on actually physically coming in here over the weekend, getting a look at the levels, and then drawing them out by hand. Now, if you're only looking at one market like the ES, then it's not a big deal. But if you want to look at a lot of different markets, that would mean you'd spend your whole weekend in here trying to get all the plus and minus levels for all the markets that you want to trade. And it's just unrealistic, right? So it doesn't look like it's that bad. Probably there's nothing wrong with it. To be able to give you some clues of what it would look like if it was bad, it stands out pretty easy. So if it was wrong, you would know, because it would look like I got some really clear examples. Say like back here, right? Look how wide this range is. Obviously, there's something wrong, right? You see a range, it's that wide. There's nothing else around it that's wide. It's very clear and obvious that there was something wrong that week, right? So if it's acting janky, we can usually spot it because it'll be something as big as that. And we're like, yeah, no, that's not the range. So it's probably okay since it doesn't look all spread out like that. It's a think or swim thing. We just make do as best we can. We are 1.5% above the 10-week. It's not exactly where we would want to be. Somewhere above 2 would be better. And we are on the decline, meaning we're getting closer and closer to that 10-week. It's not necessarily a bad thing. 10-week is considered the mean or the average. We're above our average price, but we don't want to get overstretched, right? Like we don't want to run too far, too fast, leave the mean behind, because then we'd get mean reversion and all of that. And we've been holding steady, which is what we've been discussing all morning. We've been going sideways now for half a month. And because we're going sideways, the 10 has had time to catch up to us. This is a correction. We got a correction after that really fast run back up from the first week of August. We ran really fast, kind of outrun everything, and we needed to pause and get a correction in, and that's what we've been doing. On the one hand, it's really healthy that we corrected by going sideways. This is a correction in time rather than a correction in price. Generally, when you hear correction, we fall sharply, right? We pull back really steep. This correction was a correction in time. We just sat here and we let the market heal. But now it needs to continue the move. If we continue to sit here and the 10 gets all the way up to us, we can jump underneath it. It won't act as a support. We can jump it in the overnight and run right back down again. So we're not there yet, but we're getting close. And the fact that we're under 2 says the clock is running out. It's getting closer and closer to the time where price needs to make a move. The sweet spot on the 10-day is between 1 and 1.5, and we're there. That's where we're at right now, 0.37%, more than a quarter above the 10-day. Things are looking fine. We had that run up in August from the August lows, and then we've been sitting here sideways correcting, and we overshot that 10-day. We were above it by 2.5%. So there was the move that was too fast, too far, and we needed the correction. And we've been correcting sideways, nice and healthy. But we're there. The clock's run out on the daily. We need to get away from that 10. And I don't want to use the words here yet because I don't think it fits, but we're getting really close. We need to get away from it or else. It's not quite an or else moment, but it's close. Looking at the markets over the last 5 days, a little bit of a rotation still, right? And an odd one that is a bit broken. Tech is negative, so you would think about a capital rotation and a fractal rotation out of the big tech glamour names and maybe into something like defense, utilities, healthcare, staples. But staples is basically flat, and utilities is only up 0.5%. Energy, flat. Consumer discretionary, flat. So when we look at this, we had financials, big, massive breakaway in financials, 2.5%, almost 2.75%. It doesn't sound like much, but for sleepy, boring financials, that's a big move. Industrials and healthcare at 1%, and building materials. So these are all connected to things like the financials. Construction, mortgage lending, loans for new businesses and loans for construction, and healthcare. I mean, bio alone has been crazy, and healthcare technology has been doing really good. Devices, right? Healthcare devices. So it's not a clear-cut system out there. And after Jackson Hole, when Powell said everything's about to change, well, he ain't kidding, right? Like, it's time to pivot. I think the markets are beginning to pivot. So just keep an eye on the sectors out there. We're looking for clearer guidance than this. This is just a mess at the moment. We don't have any dominance and leadership in the sectors, but we do need that capital rotation to come through. Looking at what's up this morning, we've got Bitcoin up, but it's been down. It was down more than 8%. So the fact that it's popped up this morning at not even 1% means it's still down 7.5% over the last 5 days. This is more of a knee-jerk reaction or a mean reversion in Bitcoin than it is any sort of rally. And the VIX is up. Over the last 5 days, it's up 7%, 6.25% of that today. This is a pretty generic way of looking at the VIX, but it does work. Below 15, we would be in a low volume, low volatility, bullish environment. Above 15, but below 20 means we're looking at a market in a pullback, but it's just a pullback. It's not a deep correction or, any sort of big bearish market or anything like that. It's just a pullback in the markets for now. Everything else is down or flat this morning. Semiconductors down 1.5%. Gold miners, precious metals and mining, China ADRs, tech, energy, oil and gas exploration, banks. We don't even have banks this morning. Everything else is down or flat. That's what we're lining up with this morning. So if we're going to get any sort of a rally today in the S&P and the NASDAQ, we're going to need to see the dollar calm down. We've got a new breakout in the dollar. It's trying to get it back above 102. We've got the 2-year holding these highs. Think about Friday's levels, right? We're still in the upper half of Friday. Generally, we would look at gold as an inverse market compared to, say, the indexes. But it's down with the NASDAQ, with the S&P. And I think it's reacting to that move in the dollar. Our ranges are set. We're good to go from that end. And we've got data coming that is going to be more important than any levels that we can lay out, right? The data is boss first. Look for the markets to, begin to accept the narrative. Get out of this range. Otherwise, the base case argument for today is that we stay inside of Friday's range. Maybe we wick out of it one side or the other and come back in again. But holding the range is still the baseline bet. If that fails, right, if that thesis is wrong, then we'll start to focus on the levels or the breakout beyond that. With 0.5% and then 1%, right? We're measuring this entire range from Friday's high to Friday's low. And if we were to expand outside of that range, 100% of the move, we'd get down to 55.25-ish. And of course, you could do the same thing in the other direction. That's if we can get outside of Friday's levels, right? So first we got to break out of the range. We've got to get through that sell side liquidity and above the 111. And it's still a threat of a reversal until we get through that 1, 2, 3, 6. So usually that's where we would expect opposite candle color. Maybe we pull back and we get our first pullback at that green line. Then we cut through that. We get to the round number 5,700 and then on up into 5,732 cog line. And that's the upside move. Same thing for the downside. Got to get through the buy zone first. Opposite candle color at 1, 2, 3, 6. Expect a pullback there to digest the move, then a continuation, and on down we go, right? Clear, simple levels if we actually get out of Friday's range and continue to expand. The baseline bet is that Friday's range holds. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.